Advanced Financial Accounting. In this presentation, we're going to take a look at an example problem related to the equity method. So we're going to have one company that's going to be purchasing an investment in another company. We can handle that in a couple different ways. In this presentation, we'll be taking a look at the equity method, which is typically the method that will be used when there is significant influence. So our information is going to be up top, and then we're going to post that information with journal entries going step by step through a 3-year time period to see how the equity method would play out, how it would work. We're going to then post that to a nice basic little trial balance over here so we can actually see it posting to something in a balancing format. So what we have then, information P is going to be one company. That's the kind of the parent company or the purchasing company, we'll say. So P company purchases S company 30% interest. So in other words, P purchases shares of S company and gets up to 30%. So usually, and our test here, we're not really concentrating in on when are the rules to use the equity method versus the fair value method. But normally that 20% is kind of like the cutoff unless there's some other circumstances taking place. So what we want to do is say, okay, this time we're going to say that the 30%, there is significant influence. And now let's work this problem using the equity method. In a prior presentation, we worked the same problem using a fair value method. So you could do a compare and contrast, as we'll do in a future presentation too, comparing and contrasting the two results of these problems. So we're going to have the information for S down below then, and we're going to say for 3 years, the purchase took place in January of 2000X7, and then we have 2000X8, 2000X9. We've got the net income information for S, we've got the dividend that was paid by S, and then we have the fair value of shares held by P. So these are the fair value of the shares of S that P is now holding the 30% of. Now note here, we're not going to be using this fair value information down below. We don't need this information because we're going to be using the equity method. This information down below would be used if we're using the fair value method. So first, we're going to have the transaction related to the actual purchase. So what happens when we make the purchase? Same transaction under the equity method as well as the fair value method. That being, we're going to be paying cash. Cash is going to be going down, and we're going to be purchasing then the investment for, in this case, the $81,000. That happens to be equal to the fair value at that point in time. But we don't really need this information to know that because obviously we had a market transaction here. We purchased it on the stock market, and if it's an arm's length transaction, then it would be the fair value, so you would think. So that's where we're going to start at the same spot, whether using the equity method or the fair value method. Posting that out, we're going to say then that cash is going to be decreasing, and then we have our investment is going to be increasing. So we're starting at the same point, no matter what method we use, equity or fair value, and we're at that 81,000. Then there are typically two things that could happen with company S, and we're P here. Now we're recording P's information for company S that we have a 30% investment in. They're going to have net income that they report, and they're also going to have dividends. So we're concentrating up here now for these two items. We're not looking down here at the fair value. We're not looking at our broker statement to determine what the fair value will be because we're up here applying the equity. So in this case, then we're going to say the net income, we're going to look at their financial statements and say the net income represents the increase in the equity of S. And we have a 30% interest. We have significant influence. We could kind of force them to give us a dividend if they so choose, or give influence towards that. Therefore, we should be recognizing our equity interest as they earn it. Now, if you think about this, you can kind of think the general way you would think about this is income is going up for company S of $43,000. And then of that, they typically give dividends. Now, the dividends, you could think of them coming out of the current earnings of the current year. Now, you could give dividends for retained earnings of prior years and whatnot, but the general assumption here is, okay, they earned $43,000 and they gave dividends of 14, which you would think is like 14 out of the 43,000 earnings that were earned in that year. So that's how you can kind of think of it. When should we be recognizing this? In terms of the equity method, we should be recognizing our 30% of the 43,000 income. And then when they give us the dividend, we're not going to record dividend income as we would with the fair value method, but reducing the investment. Let's see what that would look like then. So first we're going to take the investment is going up, 12,900, and income in S is going to be going up. Now what's that going to be for? Let's pull out the huge calculator here. So giant calculator. We've got the 43,000 times 0.3. So in other words, the 43,000 net income for 2000X7 times 0.3, 30% our interest. That means that our interest is going up in the investment 12,900. So we're increasing our investment not by the market, not based on what things are trading for, but based on the internal things that are going on in company S, earnings, equity, increasing our representation of our equity interest in them. Then the income is going up. So our income is going up not by when they give us a dividend, not by the external thing that they're sending out, but by the internal information that's happening in company S, that being that their revenue went up. So if we then record this, we're going to say, all right, there's 12,900, increasing our investment to 93,900. Note that that does not tie out to anything down here in the fair value method. And that's fine because we're using the internal calculation, not the market. And then the other side is going to be going up on income. So now we have revenue of that 12,900. Here's the other accounts just pulling forward. So revenue 12,900, increase in the investment. Then we're going to say the dividend happens. Well, what happens if the dividend happens? Because under the fair value method, we usually recognize dividend income at that point in time. We're not recognizing dividend income, but we're gonna get cash. So in other words, cash is going to go up. We know that. This is 4,200, which is our interest, 30% of that 14,000. 14,000 times 30%, 4,200. The other side not going, as it would in the fair value method, to dividend income, but rather decreasing the investment. So it looks like this. We're going to say, all right, there's the cash is going up. Now note, if some problems might say that the dividend was declared and we would record dividends receivable and then receive the cash. But eventually we're going to get cash. And I think for purposes of this presentation, it's best to just see the cash go up because we're going to get money. And then the other side is going to be decreasing the investment in S rather than recording income down here at the point in time we get the dividend as we would under the fair value method. So in essence, what happened? We're increasing by the net income, which our portion, 30% of the net income, which you would think would be higher than the dividends that were distributed during the time period. Then when they give us the dividends, we're reducing our investment income at that point in time. So we already recorded the income down here, the 12,900, which is higher than our dividend amount. And then we're reducing our investment up top by the dividends that were distributed to us, the dividends for which we've already recorded the income, not as dividend income, but as our equity investment in S. And then we're going to be recording the cash, of course, that we got at that time. Okay, now let's say we're going to take this ending balance and we're going to move on to year 2000 X8, only focusing on these investments. So as if nothing else is happening in the company, right? So we're just focusing in on this investments. So the equity method is going to roll out. So you'll see in retained earnings, you'll have 5,000, 12,900, and these two amounts will remain the same. So here's our beginning balances. Nothing's in the income statement. And we can think about, okay, what happens in 2000 X8? Well, and also just before we do that, note this 89.7 over here does not tie out to the ending balance that we would see on our brokerage statement. So if we got a brokerage statement, you're saying, hey, the market says it's worth 101,000. Well, we're not depending on the market. We're depending on the internal equity calculation of it. So the swings up and downs of the market aren't what we're depending on to value our stock in this case. All right. So then we're on 2000 X8. Next year, same kind of process, right? We don't have the purchase happening now, so we don't have the original purchase, but we're still going to have these two things happening, income and the dividend that's going to be paid. So we're going to take our portion of the income for the 38,000 now of the income, 30% of that, 11,400. Investment's going to go up by that 11,400. We're going to record income of that 11,400. And then if we post this out, the investment now going up 89,700 plus the 11,400, 101,100. And we could see that the income in S is going up. So the investment goes up and the income goes up. So this is revenue, not a loss. This is a credit down here. We have net income increased by the 11,400. Even though we have not yet received it, we're representing our full 30% of the net income that has been generated by S. Then S is going to give us a dividend, generally for something less than the net income that was generated. Doesn't have to be, because they could give us a dividend of retained earnings, what's in retained earnings. But the general concept here, we've got net income, the increase in value, the dividends we're kind of assuming to be given out of that current time period. So that would typically be less. So then we're going to say then cash, now we're going to record the dividend. So the dividend's going to be the 29,000, 30% of that, 30% times 29,000, 8,700. Cash is increasing. The other side going to the investment, not to the dividend income, because we already recognize the income of the 11,400, which is our 30% of the 38,000. So this 8,700 is basically already included in that 11,400, and it was included in the investment increasing. So now what's happening is we're basically cashing out some of our 101,100, reducing the investment and getting cash for it. And notice, if we had influence, it would be just like that, right? It would be as if we could just basically say, hey, give us a dividend of 8,700, and we'll just reduce the value of our investment and we'll record the cash for it. We can't do that completely because we only own 30%. So we can't force them to give us a dividend. But 30% is pretty influential in most cases. So we have strong influence in order to do that. And that's why we're using, of course, the equity method. So then we got down here the net income at the 11,400. After that point in time, the ending balance at 92,400 for the end of 2000x8. Note that once again, that does not represent what it's currently trading for on the stock market. So our brokerage statement doesn't match our ending balance here. We're not reliant on external forces, the stock market, the swings of the market. We're relying on the internal forces using the equity method, that being the equity share of the net income of our subsidiary, or not a subsidiary, our interest in company S. All right, next year, we're going to do the same thing. We're going to roll out our equities, going to now be combined together, and our ending numbers are going to be our beginning numbers over here. We're now in 2000x9. Let's do this one more time. So we're going to have the net income once again, 59,000. We're going to take the 30% of that, which is going to be the 17,700, which is what the investment will go up by. The other side, increasing the income once again. So we're going to say, all right, now the investment was 92,400. It's going to go up by 30% of the net income increase in S. We are now P, so we're recording our 30% increase, 17,700 increase up to 110,100. The other side going to the income account. So income is going up. So the revenue account is going up. Net income is going up by 30% of the net income of S. And then the dividend, once again, you would think is going to be something less than that. So if you're company S, you'll say, we made 59,000. I think we'll give out a dividend of 19,000 to all the shareholders out there, of which P owns 30%. So we'll give out a dividend of the 19,000. So it's usually something less than the earnings, you would think. It's less than total earnings. So it's less than retained earnings for sure, but we're going to consider less than earnings for the year. So now we're going to say, all right, well, we already recorded the 17,700 here of income, which is the total earnings on the year. So I'm not going to record income again, dividend income of our portion of the 19. We're going to then be decreasing the investment. So now that we already have the 110,100, including the income that has incurred, we're now kind of cashing that out in essence and saying, all right, they're going to give us a dividend, so we're going to get cash, and we're going to reduce our investment. So we're going to say, all right, now we're going to get cash is going up, and we're going to reduce our equity investment now down to 104,400. So we got the 17,700 that is the income. So that's going to be the final year. Also note that the 104,400 does not tie out once again to what we would see on the brokerage statement, as we would tie to as what we would make an adjustment entry for under a fair value method, because we're trying to adjust to the fair value using external sources. So given the equity method using internal sources, those two things will not be the same. Next time we'll take a look at a comparison between the two results of running these problems.